to March, the end of March. That would have been the prevailing annual figure. As at April 1, that was increased, and therefore, to arrive at the effective amount for 2024, we now need to take 3/12 of $1,500,096, and then we add that to 9/12 of $1,700,088. And so the threshold for 2024 will be $1,650,090. $1,650,090. Never forget that. That is it for 2024. And so now we'll go to how that will impact the employment situation. So in respect of employed persons, the threshold from January to March will be broken down over the pay cycles as we see here on the table. So we have a weekly pay cycle, a fortnightly pay cycle, and a monthly pay cycle. Now, in respect of the weekly pay cycle, what we do is after taking 3/12 of the $1,500,096, which gives us $375,024, we divide that by 13 because we have 13 weeks from the start of from January 1 to March 31st, we have 13 full weeks. So we divide that $375,024 by 13 to arrive at our threshold, or weekly threshold for that period. We're going to be talking some more about what happens effective, or what is expected to happen effective April 1. Now, the monthly threshold remains $125,008, and it is simply dividing that same 375,024 by 12. Now, Mrs. Walker would have explained to you before that the fortnightly threshold might be a little different, and because some persons would have had 7 fortnights up to the end of March. Some persons would have had 6. Because we are counting the fortnights beginning the 1st of January, we are accounting for 6 fortnights. Now, let me just reiterate. Let me just remind you that Mrs. Walker had said that if it is that your fortnightly threshold is different from what we're projecting here, you're asked to write into TAJ to get approval for that. All right, so that we would have taken care of the first quarter, January to March. Now we're moving to what obtains or is expected to obtain from April 1 to from April 1 to December 31st, 2024. We're going forward, we're not reverting. Right, so I did say that the threshold amount for that period is, we did say that the threshold amount for that period is 9/12 of the new figure. So the weekly, which is $1,275,066. Just a little, is $1,275,066. So for the weekly weekly amount of the threshold, I beg your pardon, you would divide that amount by 39 weeks because there are 52 weeks in the year. So the fact that we would have already accounted for 13 of those 52, we're now left with 39. So we divide that figure by 39 and we arrive at a weekly threshold of $32,694. Of course, we're going to go to the other easy one because we pick the low-hanging fruits first, right? So in respect of the monthly threshold, we divide that same $1,275,066 by 9 to arrive at the monthly threshold of $141,674. No, in respect of the fortnightly, again, what you're expected to do here, one of the key things about the application of the threshold, it must not under any circumstance exceed the $1,650,090. So what we suggest is that if you were to take, we had said before that you should have taken 6 fortnights, right? So 6 times the, let me just go back to that slide. 6 times the 57,696 would have given you 346,176. So what we recommend is that, you know, in order to arrive at the threshold, the fortnightly threshold for the period April to December, you are to subtract the 346,176 from the $1,650,090 and then divide the balance by 20, because again, there are 26 fortnights in the year. So given that you would have already accounted for 6, you're now left with 20 to be accounted for. And that would give you a fortnightly threshold of $65,195.70. Of course, come 2025, we will be able to apply the full threshold of $1,700,088. Right? And at that point, the weekly threshold will remain $32,694. The fortnightly will be $65,388, and of course the monthly will also remain $141,674. So I encourage you to pay keen attention, and especially for those payroll providers, you know, we need to pay keen attention to that. And I must say again, if you have for the fortnightly, if your situation is different, you need to make contact with Tax Administration Jamaica. All right, so I have my first. All right, let me go to the next slide. So we go to the application of the threshold in terms of employment. Now, in accordance with paragraph 14 of the second schedule to the Income Tax Act, for those who are mindful to, you know, look for the legislative reference, PAYE is computed using a cumulative approach. In each pay cycle, the cumulative threshold is deducted from the cumulative statutory income to arrive at the cumulative tax payable as at that pay cycle, be it weekly, fortnightly, or monthly. All right, so I have an illustration for you. So if the words are not settling with you yet, don't be daunted by that. We're going to be looking at what it ought to look like. So the PAYE payable or refundable, because it could very well be refundable, for that pay cycle is determined by subtracting the previous cumulative tax payable from the current cumulative tax payable. So if we're looking at this month is April, you would subtract the one for last month from this month to arrive at the tax payable for this month. And you're going to see the benefits of this cumulative approach. Now, using the cumulative approach to compute PAYE allows for variations in income to be reflected in the tax payable or refundable. So I ask for, let me just stop sharing this and bring up an Excel file. And just hold a minute for me, please. Just let me get it going. Thank you. Okay, so just before we go into the explanation of this Excel file, I just want to know that if you were trying to get on earlier, but you were unable to do so, we're asking you to retry. We had some technical challenges. So just to encourage, just to ask you, because if you are on, you'll be hearing me. If you have colleagues who were trying to get on earlier and they weren't able to, we're asking you to reach out to them and ask them to retry. All right. And we're also, I've been reliably informed that we're also live streaming on YouTube. All right, we're trying to serve our customers in the best way we can and try to reach as many persons as we can. Okay, so we have screened the computation of PAYE or income tax using the cumulative approach. And in illustration A, we have this table shows the computation of an employee's income for the year, income tax liability for the year of assessment 2024, where the statutory income is greater than the threshold. So remember we said that threshold is a portion of statutory income that is subject to tax at 0%. So here we're starting with statutory. And the other thing that we want to pay attention to in this scenario is that this employee took no pay leave in July, 1 month no pay leave. So we're going to look at how that plays out in using the cumulative approach. So we see here where this person's statutory income is $350,000 per month. And that goes down to December, where the person would have gotten a little bonus, a little topping up there. But we'll come back to that. The cumulative approach requires that the accumulated statutory income is utilized, right, along with the accumulated threshold. So we will see here in the second row of the table is the accumulated threshold. So sorry, not threshold, but the accumulated statutory income. So month 1, it would be 350,000. Month 2, that is doubled. Month 3, it is tripled. So we understand that going across, right? The threshold, in row 15, I had just put the monthly threshold there for your benefit, right? So if you notice now, going back up in the table, and we're looking at row 9, I trust you can see my rows as I am identifying them. You'll see the threshold of 125.08 for the first month, January, and then it doubles, it triples. But if you notice now, come April, it's not just a tripling of the 125, because the threshold for April is 141,674. So that would be the increased amount that is being applied going forward. Now, if you notice here in 10, we arrive at the accumulated statutory income per month, right? And what we do is that we find the tax on that, right? And the tax on that is computed monthly here. And then what happened? In order to arrive, when you look at February, for example, the accumulated tax payable would be 112,496. What you do to arrive at the amount for February, the tax that is payable for the month of February, you would subtract the tax that was paid in January, because the figure, the accumulated figure in February is what is payable in February plus what was payable in January. And it goes like that along the table. But if we pay attention now to July, the month of July, if you notice, there was no statutory income because this person took no pay leave. So the accumulated statutory income for July and June are the same because it did not increase in July. But let us pay attention to the threshold. Even though the statutory income remained stable, it didn't move, we notice that the threshold increased. And as a result of that, if you notice for the month of July, it results in a refund because the person is entitled to the threshold for that month. Even though the person took no pay leave, the person would have been entitled to that. And that is going to impact the overall amount of tax that the person pays by the end of the year. Now, had it not been for the cumulative process of computing, you would be taking the income, the threshold for each month against that. The threshold for each month against the statutory income for that month. And what you find is that this individual would end up with threshold for only 11 months. But as a result of this person now benefits from the threshold for the 12 months, even though there was a month where the person had no pay leave. All right. So we're moving on now to illustration B. And this one shows the computation of an employee's income tax liability for year of assessment 2024, where the statutory income is less than the threshold. Okay, all right. So for those who are not seeing the table, just to let you know that I did indicate to you before that the technical advisory has been posted to our website, and you may go there and see a similar approach to the computation of using the cumulative approach, right? But all right, so in terms of where the threshold, where the statutory income is less than the threshold, it therefore means that the individual would not be required or should not have paid any tax at all. But what we have here screened, I won't spend too much time on it since some persons are not seeing it, is that this person has statutory income of $130,000 per month. Now, you will recall that the threshold per month for the period January to March would have been $125,000. Now, what it means is that this person would have been required to pay tax on just under $5,000 per month for the periods January to March. But what we're seeing here, what is demonstrated, and when you go on our website and you go on the technical advisory, you will see that even though the person would have been required to pay tax for January to March, as a result of the increase in the threshold, that person come April will get a refund of the tax that would have been paid for January to March. All right, so I close this and I go back to. All right, so I have a question for you. And what I'm going to ask is that you respond verbally. So we're going to ask you to indicate, to use the raise hand feature to respond to this question. Do not respond in the Q&A. We're asking that you respond verbally. So the first question is, it reads, the threshold amount for year of assessment 2024 is A, $1,700,088, B, $1,500,096, C, $1,650,090, D, none of the above. I ask that you indicate by using the raise hand feature and we'll acknowledge you. Jalicia, go ahead. Jalicia, go ahead. Okay. Sylvia. Okay, Miss Jones, we're asking. I know I've been reliably informed that a number of persons have the right answer. So who is going to give it to us? Are they able to unmute and to speak? Okay, so we'll come back to that. We will come back to that. So in terms of the threshold for the employed person, just to recap that, we said that it is done on a cumulative basis. So we're going to move now to the threshold for the self-employed person. The self-employed individual computes his income tax liability for the year. Unlike the payroll situation that is over, monthly, weekly, or fortnightly, the self-employed person does it for the year. Therefore, he or she will utilize the full amount of the income tax threshold for the year against his statutory income in computing he uses it in computing the estimated obligation on the S04. And when he's reporting the final income, when it has been established on his annual return, it is utilized. And let me just explain that to you. It's not that the person gets to use the threshold twice. What happened? The law requires that you estimate your income for the year, and that is to be filed in March. So if you estimate your income for the year to be $2 million in March, you get to take the threshold against that $2 million, and you would pay tax on the difference. You would pay the estimated tax on the difference. Now, at the end of the year, when you're required to file your annual, we find that you may very well find that the income should not have been 2 million, but the actual income was actually 3 million. You utilize the threshold against the 3 million to arrive at the tax payable, right? And you then get to take as a credit the estimate that would have been paid already against the final. So the threshold technically is being applied once. All right. So for the self-employed persons now, some of you guys might have already filed your estimated obligation and utilized the threshold at $1,500,096. We're saying you may. We're not asking you to, because if you don't make the adjustment, if you don't choose to amend your estimated obligation, that is your S04A, then you would not be left out of pocket, because you also have the opportunity to adjust it when you make that final return, because it is the same threshold and it will be applied at that point. All right. Are we able to take the questions? Okay. So, Serena, we're going back to that first question. What is the threshold for this year? Serena?
Hello, morning. Are you hearing me? Are you hearing me?
Yes.
Oh, the threshold for this year is 1,650,090. That's C. Hello.
Serena?
Are you
Go
hearing me?
ahead.
That would be C, 1,650,090.
She said C. Okay, great job, Serena. You are correct. It is $1,650,090. You see, we need to repeat that as many times as possible to help to aid in retention. All right, so we're moving now to the second question. And it still has to do with threshold. Second question. Are we ready for second question? Yes. So the second question reads, all of the following persons will benefit from the increased threshold except Marcio. Go ahead, Marcio. Speak to us, Marcio. Okay. Go ahead, Marcio. Sylvia. All right, Sylvia, go ahead, Sylvia.
C would be the answer. C.
C. And the risk, that is, C says persons not resident in Jamaica. And I thank you for that, Sylvia. You were paying keen attention. And I know you would have done very well in school because you paid attention to that word except. That's the operative word there. So we say that all of the following persons will benefit from the increased threshold except persons not resident in Jamaica, because we did say that persons who are not resident in Jamaica, they are not entitled to the threshold in the first place. So anything that the pronouncement that the minister would have made recently would not impact them at all. All right, so that takes care of the exemptions. Sorry, the threshold. And we now move into the pension exemption. And again, I want you to pay keen attention to this. Of course, we'll be telling you what the changes are, but then we'll also be going into, the eligibility criteria. And that is critical too. So, for those who are mindful to do further research, the pension exemption, the legislative authority for the pension exemption is found in section 12(1)Z of the Income Tax Act. Section 12(1)Z of the Income Tax Act. Individuals and it stipulates that individuals who derive pension from any of the following schemes are entitled to pension exemption, right? So the critical thing here is that in order for a person, and you're going to need to remember this, I'm going to come back at you with it, because you need to be aware of the eligibility criteria. That's where it starts. Before we even get into the increase and how that is computed, we need to know who is entitled to pension exemption. And it is an individual who is in receipt of pension income. Never forget that. You must be in receipt of pension income to be eligible for pension exemption. We'll tell you a little bit more, because it's not all pension. It's specified pension, is pension income from specified pension schemes. And these are they which are listed here on the slide. Your statutory pension schemes, like the NIS, the government pension. And we would have heard of the one for the hotel, the tourism sector. Those would be considered statutory pension schemes. So persons who receive a pension from those schemes, they are entitled to a pension exemption. Also, persons who receive from a scheme approved by the Commissioner General under Section 44(2) of the Income Tax Act, or from a retirement scheme approved by the Commissioner pursuant to Section 44(a) of the Income Tax Act. Now, the second and third bullets there, they are really private pension plans. They are private arrangements, and that hence the need for the approval by the Commissioner. But I want to pay attention to the fact that an individual whose only source of pension income is from outside of the island, that person is not entitled to an exemption. Let me repeat that. To the extent that a pensioner, so a person can be a pensioner and not be eligible, but that is where the pension income is received from outside of the island, because it has to be the pension exemption is associated to statutory pension schemes and these other two arrangements which are approved by the Commissioner. All right. Now, having established the the fundamental criteria for a person to be eligible for pension exemption. What we're going to now be doing is we're going to be looking at how that pension exemption is utilized, right? How it is to be applied. So person is in receipt of pension income, and it is either from a statutory pension scheme or one of those private arrangements that the commissioner would have approved, right? And when I say private, I mean, because in terms of pension, it is a fund that an employer would establish with one of those institutions that manage those funds. So it's not, whereas, so that would be for pension, and then the retirement scheme would be what, as for example, a self-employed person can approach one of the, so it's not a group, whereas the pension scheme is a group arrangement. The approved retirement scheme, an individual may approach any one of the finance houses that that provide that service and become a part of that, subject to their, they're meeting the criteria. So, having established that, we're going to now be looking at how the pension exemption is applied. And no, this is where age comes into play, but it is not as a result of your age that you're entitled to a pension exemption. No, it's not as a result of your age or your status that you are entitled to pension exemption. You have to be in receipt of pension income. Now, if you're in receipt of pension income, and there's a reason I'm repeating, guys. To the extent that you're in receipt of pension income, the pensioners who have attained the age of 55 years or is certified to be permanently incapacitated, they may use the pension exemption against all their sources of income. On the other hand, for the person, the pensioner who has not attained the age of 55 years, they may only utilize the pension exemption against the pension income. So once you are 55 years and over, or you are certified to be permanently incapacitated, you may utilize the pension exemption against all your sources of income. So let us go with an example here now. If a person who is over the age of 55 has pension income, well, currently the pension exemption for 2024 is $207,530. I will tell you how that is computed later on, but let us just work with that figure now. It is $207,530. Now, to the extent that a person who has attained the age of 55 has pension income that is less, say they have pension income of $150,000, right? Then they may utilize, the pension exemption can be utilized against all their sources of income, right? So it's not restricted only to the pension exemption, because if it were, then they would, even though the maximum pension exemption is $207,530, they would not be able to utilize more than $150,000, because that is what their pension income is. But the fact that they can use it against all their sources of income, there is no restriction there. as well, and that is the same for a person who is certified to be incapacitated. Now, let me hasten to say as well that the person who is certified to be incapacitated, there's no age restriction. So that person could be 30 years old, 35 years old. As long as you are certified to be incapacitated, your pension exemption can be utilized against your income from all sources. I know that a number of persons tend to associate pension with retirement, right? There are a number of working persons who have not reached the age of retirement, who are in receipt of pension, probably from some previous employment. They are in receipt of pension, so they are pensioners. So it has not, in terms of the utilization of the exemption, I'm repeating, if you have attained the age of 55 years or you're permanently incapacitated, it can be utilized against your income from all sources. If you have not attained the age of 55 years, it may be utilized against the pension income only. So in the scenario that I had given before, if the pension income is $150,000, even though the maximum exemption that's available is $207,530, you would not be able to utilize more than the $150,000 because you're not allowed to use it against any other source of income. All right, so how did we arrive at that figure of $207,530? The minister had said that it should increase to $250,040, right? And that is up from $80,000. But just like the threshold, because the effective date of the increase is April 1, 2024, the revised entitlement is shown in the table below. And so because what we're going to do is to take 3/12 of $80,000, which is $20,000, and we're also going to be taking 9/12 of $250,040. And when we sum those two results, we arrive at the $207,530. Now, effective 2025, persons will be able to utilize the full amount that the minister would have announced, the $250,040. No. So we're looking at the pensioner. What are the maximum tax-free entitlements for a pensioner who is under the age of 65 years? That person would be entitled to the pension exemption as well as the threshold. Now, we're not saying that the threshold is an exemption. Notice what we're speaking of here is the annual maximum tax-free entitlements, right? And so that would be the pension exemption of $207,530 plus the income tax threshold of $1,650,090. That would give us for 2024 a total amount of $1,857,620. Now, come 2025, that amount will go up, marginally, because you'll now be benefiting from the full amount of the threshold and the pension exemption that the minister would have announced. All right. So for persons who are permanent, we made mention of the treatment of the exemption for persons who are permanently incapacitated. And this is a pensioner who is permanently incapacitated. Persons who are so certified will be allowed the pension exemption of $207,530 for 2024 and $250,040 for 2025. And just to repeat, this exemption may be applied against all sources of income for this group of persons, irrespective of their age. We said before that they don't have to, the 55, the age of 55 does not apply to this person who is certified to be incapacitated. No, we're going somewhere here. So we're asking that you pay keen attention and follow. Now, based on section 12(1)(y) of the Income Tax Act, emoluments of an individual who is permanently incapacitated, emoluments, they are exempt from income tax. So any emoluments, whatever the class of emolument that a person who is certified to be incapacitated gets, it is fully exempt from income tax. Now, in terms of the certification, the permanently incapacitated person must be certified by the minister responsible for Social Security on the advice of the Chief Medical Officer to be a person suffering from a disabling permanent physical handicap or a permanent mental handicap. So as employers, we encourage you to, to the extent that you have persons who are incapacitated in your employment, encourage them to get certified, because then their emoluments would be exempt from income tax, right? Now, when we speak about permanent physical handicap, we're not talking about a broken leg. That's a temporary physical handicap. So if the person has lost a leg, God forbid, that is permanent. Anything, they have lost their vision, that's permanent. So the thing though, it is not for the employer to look on and say, oh, you only have one leg and so we're not going to tax you. Even if you only see one leg, you are required, the person is required to be certified to have one leg. That's the basis on which the exemption applies, right? So that is it for certification. Now, continuing with permanently incapacitated pensioners, a pension income falls within the definition of emoluments. Remember, we had said before that the emoluments of a person who is certified to be incapacitated is exempt under section 12(1)(y) of the Income Tax Act. Now, given that pension income falls within the definition of emolument, what it means is that the pension, the pension income of a person who is permanently incapacitated is exempt in totality under section 12(1)(y). So because pension income falls within the ambit of emoluments, and we did say that emoluments are exempt for the person who is permanently incapacitated, then it follows that the pension exemption, the pension income of a person who is permanently incapacitated is exempt in its totality. Now, to the extent that this pensioner has income from other sources, he may utilize the pension exemption or portion thereof provided for under 12(1)(z). Remember when we started out, we said that the pension exemption is the legislative authority for it is found in section 12(1)(z) or 1(z), depending on where you're from, right? But we have now introduced another exemption under section 12(1)(y) that could possibly make the full pension income exempt, right? To the extent that a person income, to the extent that a person's only source of income is from pension, and that person is permanently incapacitated, then the pension income is exempt. And by virtue of the pension income being exempt, then that person would not now have any more income to utilize the pension exemption against. But to the extent that the person has other sources of income, the person may utilize the pension exemption against those other sources. Okay, so we're on for question number 3. And my tech team is working with me on this. Question number 3. Pension exemption is available to A, all pensioners, B, persons who have attained the age of 55 years or is permanently incapacitated, C, persons in receipt of pension from a specified pension scheme, D, all of the above. What's the answer? Please raise your hand and you'll be acknowledged. Safoy, I hope I got that pronunciation correct.
All right.
Go ahead.
So the answer is B, persons who have attained the age of 55 years and are permanently incapacitated.
Repeat that for me.
The answer is B, persons who have attained the age of 55 years and are permanently.
Okay, thank you so much. You are correct. It is C. It is persons in receipt of pension income from a specified pension scheme. It would not be all pensioners because that would include persons who are in receipt of pension from an overseas source. And we say the pension exemption is not available to those persons. Right. So thank you very much. You have been paying attention. Okay, so we're moving on to the self-employed person who is permanently incapacitated. Now, a self-employed individual who is certified to be permanently incapacitated and is in receipt of income from an approved retirement scheme is entitled to the pension exemption. Remember, we said that the pension is usually a group fund that is put in place, established by the employer. Now, the self-employed person would not have the benefit of that. And so the self-employed person may approve one of the investment houses that provide this approved retirement scheme option and be a part of that. Now, to the extent that this person who is or was self-employed is now in receipt of the payouts from that scheme, that person may also utilize the pension exemption. And the thing about it is for the self-employed person, it may be utilized against this exemption may be utilized against their income from all sources. And of course, the amounts remain the 207,530 for 2024 and $250,040 for 2025. So that takes care of the pension exemption. And we're going to be moving now into the age exemption. All right, so the legislative authority for the age exemption is section 12(1)(a)(b). Now, an individual who has attained the age of 65 years or attains that age during the year is entitled to the age exemption. Let us not get it confused now with pension exemption. For pension exemption, you have to be in receipt of pension income. It matters not what your age is, except for how it is the pension exemption is applied. As it relates to the age exemption, all you need to do is attain the age of 65 years. Once you have attained the age of 65 years, you're entitled to the age exemption. And again, this exemption may be utilized against your income from all sources. And what is more important is that no prorating of this exemption is required. So to the extent that I attained the age of 65 years in November 2024, I am entitled to the age exemption for 2024 and beyond. Once you are at that age or you attain that age in the year of assessment, you are entitled to the age exemption for that year. All right. Moving right along, you would have seen a table that looks pretty much like this, because the age exemption and the pension exemption, they are the same amounts, they are computed in the same way. Both of them, the increase would have become effective April 1, 2024. And so the method of computing the amount, the effective amount for 2024 remains the same. And I would have gone through it before, so I am fairly comfortable that you are, comfortable with it. What happens, guys, if it is that you want to verbalize a question, at the end of the session, we will take those questions. You may go ahead and type your questions in the chat and in the Q&A, not discouraging that. But if it is that you want to ask a question, you want to verbalize a question, we will take those at the end of the session. All right. So the entitlement of a pensioner, 65 years of age and over. Remember, we looked at a table before that showed us the entitlement in respect of a pensioner who was under 65 years of age. And when we did that, we said that the only exemption that that person would have been the exemption would be the pension exemption, and then they would be entitled to the threshold, which is the tax-free entitlement, not an exemption, but the tax-free entitlement. So in this scenario, this pensioner has now attained the age of 65 years of age. And so this person is now entitled to the pension exemption as well as the age exemption along with the threshold. And we see now where this would, for 2024, the total tax-free entitlement here as a result of these three items would be $2,065,150. That will increase in 2025 to $2,200,168. Now, always bear in mind, though, that it is subject to the individual having enough income to utilize all three. Because under no circumstance will an exemption or the threshold put you in a negative income position. Right? So you can only utilize, or the individual may only utilize these exemptions and the threshold up to the point where they have income to utilize it. Okay, I'll come back to the question. So pension and age exemption, we're going to go into some general information regarding how these are to be treated, because we gather that, you know, a number of persons, especially with the increase now, they are concerned about whether or not they should seek approval from TAJ, you know, in respect of the application of the increased amounts. So these are the guidelines, right, to be used in administering this aspect of the exemption. First of all, we look at how employers should treat with this matter. And we say on the basis of proof of the employee's entitlement to the pension and or age exemption, employers may utilize the revised exemption amounts in computing the income tax and statutory deductions of their employees. So we're not asking all the AJ to say, please give me an approval to take to my employer so that they can apply the increased amounts. No. Once you're satisfied that the employee is entitled to it, go right ahead and apply the increased amounts. Then the second bullet basically indicates that where an individual who is entitled to the exemption in question, or the exemptions in question, is desirous of appropriating them to income from multiple institutions, that individual must apply to TAJ for approval, because that situation has to be managed. Right? So to the extent that you want to, if I just step back a little bit, yes, to the extent that for 2024, you want to utilize this $2,065,150 against your income from several institutions, you must apply to TAJ for approval of the amount to be applied by each institution. Now, where pensioners have been utilizing the full amount of their pension and or age exemption against their pension income, they are not required to apply to TAJ for approval to utilize the increased amounts. So you're getting your pension from X place. They were applying $80,000 for age, $80,000 for pension, because you are entitled to those. What we're saying is those institutions may now go ahead and apply the increased rates. On the basis of proof of the pensioner's entitlement, administrators of the funds may utilize the revised amounts without approval from TAJ, just for repetition, right? Repetition just for emphasis. Now, pensioners for whom TAJ had previously granted approval for prorating of determined amounts are required to apply to TAJ for determined amounts. So, ladies and gentlemen, please be guided by this. Please be guided by this. If you are employed in an employment situation, no approval. The bottom line, and to the extent that you're using it at one institution, you are always using it at that one institution, you don't need to apply to TAJ. The only time you need to apply to TAJ for approval is when it is to be split among several institutions. All right, so we're about to go into our scenarios, and then I'll take your questions after we would have any question that you care to verbalize. I know our chat monitors are doing an excellent job. I commend them. All right, so we move right now to scenario 1. And I'm going to ask you again to use the raise hand feature as we work through these scenarios. All right. So in year of assessment 2024, a 70-year-old pensioner who is resident in Jamaica has the following income streams. Person has pension from UK of $3.5 million, rental income in Jamaica of $6 million, director's fees in Jamaica of $1.2 million. I'm asking you to state the exemption or exemptions to which he is entitled and the amount. Raise hand. Miss Brown, go right ahead.
I think that's
Miss Brown?
Bowen. I think that's Bowen. It is the pension exemption, the age exemption, both of which are $207,530, and the income tax threshold, which is $1,650,090. Hello?
You did say that the person is entitled to pension exemption.
Yes, pension and age exemption, both of which are $207,530, and the income tax threshold, which is $1,650,090.
Okay, all right. So first of all, the question asks for the exemptions. And remember, I had said before that threshold is really, it's a tax-free entitlement, but it is not an exemption.
Okay.
So the question the response I'm expecting now is whether it is age and pension exemption, right?
Okay, gotcha.
We'll talk some more about the threshold entitlement, but for now, we just want to focus on age and pension exemption. And you're saying that the person is entitled to the pension exemption. What is the basis for that? What is your basis for saying that the person is entitled to pension exemption? Okay, go ahead, Carlene.
Good morning.
Good morning.
Okay. I think the basis for that would have been the fact that the person is a resident of Jamaica because they have a rental income in Jamaica as well as a director fee in Jamaica.
Right. Would that entitle them to pension exemption?
pension exemption, if it is that pension exemption.
All right,
If
let me
there
ask
have
you
been
one
an
question
income.
to assist.
Mhm.
What is the basis that entitles what entitles a person to pension exemption?
They must be getting a pension income. If they're 55, get 55 years old, getting a pension income.
If you're 55 getting a pension income,
Receipt of a pension income.
of a pension income.
Right. Not hearing.
Yeah. Okay. So you're saying the person is in receipt of pension income.
If the person, all right, if a person is 55 years or they are incapacitated and they are getting a pension income, then they would be given this $2,007, whatever different.
Okay. Let us go look back at are you able to see the screen still? Let us look back at the scenario because we're going to clear this one. And I'm grateful that you are participating and you're trying to process it, and I commend you for that. Sashana? What is it about pension income? Yes, the person is in receipt of pension income, but what other criteria must be met? Ms. Johnson, I gather your hand is up. Ms. Johnson? All right, another Johnson, Ms. Laverne.
Yes, it's the criteria is the age.
Okay,
Are
so
you-
the main criteria,
It's two
are you saying
criteria.
the main criteria for getting a pension exemption is the person's age?
No, it's based on the person being a resident of Jamaica and the age.
Okay, all right. What I'm going to do is to just let us review what was said earlier. And hopefully, we will clarify some of the kinks that we're having right at this juncture. Now, for pension exemption, the fundamental criteria is that you must be in receipt of pension income. The other thing is the pension income must be from a statutory pension scheme in Jamaica or it must be from an approved pension or retirement scheme. Remember that slide? So yes, the person must be in receipt of pension income, but then it must also be from one of those specified schemes. In the case at hand, this person is in receipt of pension income, all right, but where is he getting the pension income? He's getting not from a statutory pension scheme or one that is approved by the Commissioner General. And therefore, he would not, is a he, right? Well, he or she would not be eligible for the pension exemption. Is that clear?
Crystal,
Mackenzie? Is that clear? I
Yes,
need to
it
get
is.
a response because
It is clear. It is.
I repeat, if it is not clear, I will repeat, because you must leave here with a clear understanding of this, ladies and gentlemen. Rito, go ahead, Rito. I need to hear from you.
Good morning. I put the answer in the chat. I was thinking if the person is getting a pension from overseas. Is that correct?
Yes, you're correct. The person is getting pension from overseas.
Okay.
So would that entitle the person to pension exemption in Jamaica?
Yes, I think so.
Rita, you respond, please. Rita?
Can you hear me now?
Yes.
Yeah, I was thinking that if the person gets the pension from overseas, then they're not required. They are able to get an exemption. I'm not sure. Is that correct?
Okay, so you are correct, Rita.
Okay.
The pension exemption is the pension income from overseas does not entitle a person to pension exemption.
Okay.
Remember, we said that it has to be from a statutory pension scheme or one of those that would have been approved by the Commissioner General. The ones from overseas would not fall in any of those two categories.
Okay.
And I trust that that is clear. So here it is though, this person is 70 years of age. What would that, how would that affect his entitlement to exemption? Vivian, go ahead. Are you hearing me, Vivian? All right, Vivian is not talking to me. Don't know what I did to him or her, but so I'll go to Claudia instead. Claudia?
Can we see the question again, please?
No, I'm asking the fact that this gentleman or this person is 70 years old. Would he be entitled to any exemption as a result of that?
Yes.
And if so, what is it?
He would be entitled to age exemption because he is over 65 years.
Excellent. Thank you for that. You are correct. And so the response to scenario 1 is that this person would be entitled to the age exemption only. And for 2024, that amount is 207,530. Person would not be entitled to pension exemption because the source of the exemption does not fall within those specified under Section 12(1)(z) of the Income Tax Act. All right. So that takes care of scenario 1. Scenario 2. We're still on a pension and age exemption. John Mark is 50 years of age. He is certified to be permanently incapacitated. For the year of assessment 2024, he is in receipt of interest income of $15 million, as well as income from other sources, not including emoluments. So he has probably some other investment type income, probably trade income, other types of income outside of emoluments. He is 50 years of age. So I'm going to ask, does he qualify for the age exemption? Barrington, go right ahead.
Hello? Can you hear me? Hello?
I'm hearing you. I'm hearing you, Barrington.
Okay. Good, thank you. Good morning to everyone. He would be qualified for exemption due to incapacity.
Okay, thank you for that, Barrington. Which of the exemptions, though, would he be entitled to?
Which one?
Anybody want to help out Barrington while he
trying to
processes
see here,
that? Gareth, go ahead.
Because he is not over 55, so that would rule out age exemption. But because he's incapacitated, then he would be qualified for that. In terms of the amount that he is earning, he would be qualified for the one. What is it? 207,530.
Okay. All right, let's process that now.
Are you hearing me?
All right. Based on his age, he's 50 years of age. Does that entitle him to age exemption? I think you were saying no.
No, because it stipulates that is, well, because he's incapacitated, age wouldn't matter, would it?
No, but we have to process. Let us not cross the two exemptions, right? Let us think about them one at a time, because they're separate eligibility criteria, right? for them. Now, what is the eligibility criteria for the age exemption?
To be disabled.
Okay, so the question is, what is the eligibility criteria for age exemption?
He must be over 55.
All right, thanks for that. Anybody else want to assist?
You hearing me? This is God.
Anybody else?
Hello?
It's really 55 or over, I believe.
55 or over?
Yes, I believe that's it.
All right, I heard a gentleman just now.
Hello?
Yes, go ahead, sir.
Yes, I don't think this person would be eligible for any exemption. He has not attained the criteria for age. He's not in receipt of a pension, and even though he is incapacitated, the requirement there is that his income must be from emoluments. And based on the scenario, his income is not from emoluments, so he would not be entitled to any exemption.
We're not hearing you. We're not hearing you at all. Oh, Lord.
You're muted.
We're still not hearing. Administrator, we're not hearing.
The host need to
Sorry, we
unmute
didn't
her.
hear a word you said a while
We
ago.
didn't hear a word
Okay,
after the
all
gentleman
right.
spoke.
I'm saying my last respondent there hit the nail on the head. It was correct. His response was spot on. Because he said that Mr. John Mark had not met the criteria for the age criteria. He's only 50 years old. And the second thing he pointed to was that Mr. John Mark is not in receipt of pension income. And therefore, he is not eligible for either of the two exemptions. Sir, you were spot on. Thank you for that. Right, so the slides, will explain further. No, he's not entitled to either of the two. All right. Is there anything that needs to be clarified? Is there anybody for whom what we have dealt with so far is still not clear? Because I hear persons talking about 55 for the age exemption, and 55 years of age was not mentioned in relation to the age exemption. Only one age was mentioned, and that is 65. 65. Not 55. So is there, well, I take it that you're typing your questions in the chat or in the Q&A. All right. So we're moving on to the third scenario. And it reads, Miss Wright is 65 years of age. She is certified to be permanently incapacitated. Pay attention to the details now. She is 65 years of age. She is certified to be permanently incapacitated, and she's in receipt of pension income of $2.5 million from an approved pension fund, as well as rental income in the year of assessment 2024. So she has two sources of income. One is from an approved pension fund. She also has rental income. She is 65 years of age. She is desirous of getting clarity on her exemption entitlements. I'm going to ask one of my participants to advise her. Colin, go ahead. Oh, sorry. Karen Lewis, go ahead, please.
She would be entitled to both pension and age because she is getting a pension income and she's certified permanently incapacitated, as well as she's at the age of 65.
Let me just remind you, you're to advise her about her exemption entitlements. So we can leave out the threshold for now, guys. Just advise her about her entitlement, her exemption entitlements. Remember, threshold is really not an exemption. So right now we're focusing on exemptions. She wants you to tell her what exemptions should be entitled to.
Yes. Hello? Hello?
Okay. Go ahead, Karen.
Yes, that's what she's entitled to, both pension entitlement and age entitlement.
Okay,
Because
so
she's yes, because she's over the age. She's
Karen
at the age
is
of 65.
saying age and pension exemptions. And
Yes.
I'm not disagreeing with you, Karen. But is there anybody else who can think of anything else based on the situation at hand?
Hello? Hello?
Go ahead, go ahead.
Okay, I would advise her that the entire pension income would be exempt because she's permanently certified to be permanently incapacitated, and she could apply the age exemption against the other income.
Okay, thank you very much, Garth. Really appreciate that. But I would like for somebody now to bring it, to put it all together in one nice little package for me. I'm hearing bits and pieces, and I'm not disagreeing, but we want somebody now to just take it home. Sharon, go ahead, take it home for us. Sharon? Or is there anybody else who wants to just put it all together for us?
I'll take a
Yes,
try.
they could apply to the
Yes,
age
Sharon, go ahead,
income.
Sharon. Sharon, are you talking?
May I?
Sure, go ahead.
By virtue of her age, 65 years, she's entitled to for age exemption. The fact that she's
Agreed.
permanently incapacitated, she's entitled for all of her income to be exempt. And then because she's over the age, or she's pension age, then she's entitled to a further 207,530.
Okay, thank you for your contribution, Claudia. All right, but there is still a missing link, and I think Claudia would have, sorry, Claudia, there is something that you would have said a while ago that I'm not sure I'm in agreement with, but we could always tidy that up. Miss Lewis, go ahead. Miss Lewis? All right, so let us go then. I'll explain, but the thing is, I want to get your participation because I want to ensure that you understand it's not just about me talking, it is about you grasping the material. So when you go back to your desk, you go back to your offices, you will be able to function using these lessons. CASR, I'm not sure is that an acronym? Okay. CASR Professional Services, you want to chime in and give your analysis of this scenario? CASR, I'm sure this is something that you will have to face, that you face on a daily basis. Okay. All right. So Miss Wright is 65 years of age, and that entitles her to the age exemption. No, she is in receipt of pension income from an approved pension fund, and that entitles her to the pension exemption. Also, she is in receipt of pension income, and remember we said before that pension income is classified as emolument. And for a person who is permanently incapacitated, emoluments are exempt from income tax. So there are 3 exemptions that are available to Ms. Wright. She gets full exemption under Section 12(1)(y) of the Income Tax Act on her pension income only. One of the persons who responded said that because she's incapacitated, she would have gotten exemption in respect of all her income. Let us just clarify that. Emolument is a source of income, but not all income would come within the ambit of the definition of emolument. Emoluments are, it's income that is received in relation to employment. So we need to clarify that wherever we see the term emolument, it is in relation to income from employment. So the person who is certified to be permanently incapacitated is entitled to exemption in respect of their income from employment only. So to the extent that that individual has income from other sources, right, those other sources, the income from those other sources would be taxable. So in the case at hand, the rental income for Ms. Wright is not exempt from income tax it's not exempt from income tax as a result of her disability. However, she would be able to utilize the age exemption and the pension exemption against the income, the rental income. Because remember, we said that for the person who is certified to be permanently incapacitated, they get to utilize their pension exemption and their age exemption against all sources of income. So let us, in this case, we're saying here that the $2.5 million that she gets for pension income, that is fully exempt. Earlier on, we would have said that you pay tax on statutory income. Statutory income is your gross income less all allowable exemptions and deductions. Now, if it is that, not if, given that Miss Wright is permanently incapacitated, then the $2.5 million here would not form a part of her statutory income because that would be exempt. So it is just the $8 million that would be used to determine, well, after taking whatever deductions, allowable deductions and exemption from the $8 million, that would leave her with statutory income to which tax is applicable. So let us take, for example, that Miss Wright, if her only source of income was from the pension income. Forget the $8 million now for a little bit. Her only source of income is the pension income. She is still 65 years of age. She is still permanently incapacitated. She is in receipt of pension income of $2.5 million. What you find would happen here is that she would be entitled to full exemption in respect of the pension income, which is classified as emolument under Section 12(1)(y). Therefore, she would not have any statutory income to utilize the other two exemptions, the age exemption and the pension exemption against, because her statutory income would now be zero. But what we're saying now, given that she has other sources of income to utilize the age and pension exemptions against, she is able to do so. And I trust that that clarifies the matter. Any last question on this?
Question. It therefore means
Any
that a person can get pension.
Okay, all right. So we're moving right along. We have two. Patricia?
Yes, I was asking a question.
Patricia Bowen?
I'm here. Are you hearing me? Are you hearing me? Can I go ahead?
Okay.
You're not
Patricia,
hearing
just
me?
hold on a second for me. Yes. Go right on.
Okay, so I was asking as a takeaway, right, that a person can get up to 3 exemptions: the pension, the age, and the incapacitated. Is that correct? If they are approved and allowed, if they have fulfilled all the criteria.
Yes, to the extent that they meet the criteria and they have the level of income to utilize all three, then they will be entitled to all three.
Okay, thanks much.
You are most welcome. Sharon, go ahead. Sharon? Okay, Sharon, unmute your mic and go ahead, please.
No, I did not raise my hand.
Okay. All right. So we'll move right along. Okay, go ahead, Abigail. I don't want to leave anybody behind. Abigail, go ahead, unmute your mic and ask.
I'm not hearing anything.
Same here, not hearing a thing.
Just give us a second. I'm trying to resolve what's happening.
Okay. So
we're hearing you now.
Let us go with the age limit for statutory, for taxes and statutory contributions. We're going to, we need to understand these or this information. We need to be clear on it in order to appreciate the next scenario that we're going to be treating with. So this is just a little reminder. There was there has been no change in respect of age ranges in recent times, right? This has been for years now. So in respect of NIS, the retirement age is 65 years. So a person would be required to pay NIS between the ages of 18 to 65 years. Now, to the extent that a person continues, male or female, continue to have gainful employment beyond the age of 65, then they are required to continue to pay NIS until they retire or they attain the age of 70 years. So if I were to stay with TAJ until I'm 65 and I don't retire at 65, I would continue to be required to pay NIS until I retire. So say I decide to call it a day at age 67, then I'd pay NIS up to age 67. But if I don't and I continue until I'm 70 years old, that's when it ends. That's the deemed retirement age. So even if I were to be here, until I'm 71 years old, when I go beyond the age 70, I would not be required to pay NIS again. So there's a deemed retirement age of 70 years. Now, there may be slight variations in relation to that, because I know for some women, based on when they were born, their retirement age is not 65 years, but some 65, 62, 63. So the principle is, based on when you were born, your retirement age is determined. Your deemed retirement age is 5 years after that. So I came across a case just recently where the person's actual retirement age based on when she was born is not 65, but it would have been 62 years old. So her deemed retirement age would have been 67 years and not 70. But the deemed retirement age goes up to 70. It does not go beyond 70 years because the retirement age is 65. And when you add 5 to 65, you get 70. So the deemed retirement age, the maximum deemed retirement age is 70 years. All right. In respect of NHT, you pay NHT between the ages of 18 to 65 years, regardless of the source of your income. Whether you are employed or self-employed, you stop paying NHT at 65 years of age. And it is paid by persons who earn above minimum wage. So in addition to the whole age requirement, you must be earning above minimum wage in order to pay NHT. In respect of education tax, for employed persons, they pay education tax between the ages of 18 and 65 years. For the self-employed individual, there is no upper limit for the payment of education tax. I beg your pardon. And of course, height is just there for completion because the employee does not pay that. That is something that is paid by the employer. And we're going to now look as well at the rates of tax, because this again will help to appreciate the scenario. For NHT, for the employed person, the employee pays 2, the employer matches it with 3%, and that is computed on gross emoluments, that top figure. NHT is paid on gross emoluments. Now, NIS is 3% for the employee and 3% for the employer. Again, that is on gross up to a maximum of $5 million. So there is no Jamaican who is required to pay NIS on any amount, no, in 2024, in excess of $5 million, regardless of how much they earn. Education tax is 2.25% for the employee and 3.5% for the employer. But no, that is on statutory income. And we have been saying that statutory income is your gross income less all allowable exemptions and the deductions. If you note, education tax and PAYE, they are computed on the same base. Both are computed on statutory income. Whereas NHT is on gross without limit. NIS is on gross up to a limit of 5 million. Right? So we now move on to PAYE. We say PAYE is computed on statutory income, but for the individual, there's a three-tiered, the individual has a three-tiered rate structure. The threshold is subject to tax at 0. Every dollar greater than the threshold up to $6 million is subject to tax at 25. And every dollar in excess of $6 million is subject to tax at 30%. Now, one of the questions that I got out of the previous session is, when does the 30% apply? Does the person have to earn the level of income of $6 million before it is applied? And the answer to that, just in case anybody on this in this session is interested in that, the answer to that is no. No, every dollar in excess of $6 million is subject to tax at 30%. Now, in any month, what the legislation provides for is that in any month that the employee's statutory income exceed $500,000, the difference is to be taxed at 30%. And why $500,000? $500,000 is 1/12 of 6 million. So it is a monthly application. So what you might find is that an employee may be earning below $500,000 per month, but there's a month when that person gets some back pay, some vacation leave pay or something, or bonus or something that pushes the person over the $500,000 mark. In that month, the person would pay tax at 30% on the statutory income in excess of the 500,000. However, because of the cumulative approach of computing PAYE, it will, the person, to the extent that the person would, by the end of the year, not have exceeded the $6 million mark, the person would be refunded gradually in respect of the amount of tax that would have been paid at 30%. All right, so we're moving now to our next scenario. Is there any question in respect of the application of the rates or the age range for these statutories? Marjorie? Go ahead, Marjorie. Marjorie, please unmute and ask your question. Donna?
Good afternoon.
Good afternoon, Donna.
Yes, so you mentioned that if the person earns below minimum wage, they wouldn't be required to pay NHT, but the person can
That's correct.
volunteer to contribute though?
To the extent that they want to contribute to NHT, they would have to go and get permission to contribute voluntarily at NHT.
Okay, thank you.
That is not something that would go through TAJ at all.
Okay, personal matter.
Right, they would need to go to NHT and make an application for, you know, voluntary contribution, and they would pay their contributions there. Have I answered the question?
Sure, thank you.
Okay, you're most welcome. Andre, go ahead. Andre, please unmute and ask the question. All right, Andre has left me. Hi, Andre. Thanks very much, Andre. We'll move along. You may ask the question at a later date, Andre. Keisha, go ahead.
Hi, morning.
Good morning.
Yeah, my question is, for example, why is it that whenever you get like a tax credit, right? You get a tax refund. So it is added back to your emolument and it is taxed again. Can you shed some light on that?
When you get a refund in the context of employment?
Yes. So on your pay slip, you would see it on the side of your gross emolument. So it is included in that. And then it means that once it is total in that, then it will be automatically taxed again.
Okay, so that is a matter that we would have to get more specifics on before we can give a response, because in the general scheme of things, your refund should reduce your tax liability. So what I would ask that you do is that you reach out to us, because we're going to have to ask you for some more details, which probably this is not the forum for.
Okay. No problem. Thanks.
All right. So you can reach out to us individually and we will address that one.
All right. Thank you.
You're most welcome. Okay. So we're moving into our fourth scenario. And in this scenario, the ultimate aim is to look at the impact of the increased threshold and exemption on an individual's tax liability. Now, John Jones is an architect who is employed to ABS Limited. In 2023, he was 67 years of age and had emoluments of $7,500,000. He also had pension income of $1.5 million from an approved superannuation fund. Required, calculate his income tax liability and net pay. Calculate his not net pay, net income. What would he? So we're looking at Mr. Jones as an individual. What would be his overall tax liability? In terms of the mechanism, how it is going to be computed, that's not the focus here. The main focus is from a personal standpoint, what does his income tax liability look like? So here it is, we're going to be computing it for 2023. And then the second bullet says his income has remained the same for 2024, and we're asked to calculate his income tax liability and the net income for that year. So what I'm going to do, I'm going to be working through 2023 with you, and then hopefully we can, I'll ask you guys to work on 2024. But don't be daunted. We're here to support each other. All right. So for the year of assessment 2023, Mr. Jones would have had, remember how old is he? He is 67 years old, right? He was 67 years old in 2023. All right. And he had gross income of 9 million. By my calculation, that is 7.5 plus 1.5. No, he is in receipt of pension income, and therefore he would have been entitled to the pension exemption, which in 2023 was $80,000. Mr. Jones was, by virtue of him being 67 years of age, he would have also been entitled to the age exemption, which was $80,000 too. And of course, his NIS, remember we said that there is a cap, you pay NIS on gross up to $5 million, right? So his NIS for the year would have been 3% of $5 million, which would be $150,000, right? So his statutory income is the 9 million less all these two allowable exemptions and this one allowable deduction would result in him having, when you take these from his gross income, you'd be left with statutory income of $8,690,000, right? In 2023, the threshold for that year, so remember now, we said as well that the individual has a three-tiered rate structure, income tax rate structure. The threshold is subject to tax at 0. Every dollar above the threshold up to $6 million is subject to tax at 25%, remember that. And then every dollar above $6 million is subject to tax at 30%. So if we were to go with that now, the statutory income here of $8,690,000 would be taxed as follows. The 1.5 million, there would be no tax, or that would be taxed at 0, at nil. Then the amount to be taxed at 25% is going to be $6 million less the threshold. Because remember, we say it's every dollar above the threshold up to $6 million that's subject to tax at 25%. So that leaves us with $4,499,904. 25% of that is $1,124,976. The statutory income that's subject to tax at 30% would be the $8,690,000 minus the $6 million. So that leaves us with a taxable amount of $2,690,000. 30% of that is $807,000. So the total tax that is payable by Mr. Jones is $1,931,976. And so his total, to get his total deductions, you would add the $150,000 to that in order to arrive at that figure. But let me ask a question. If you notice, no education tax, no NHT was computed for Mr. Brown. Why? Mr. Jones, why? Tracy Ann, go ahead. Miss Whittle?
Okay, are you able to hear me?
Yes.
Because the maximum age is 65 for that deduction to take effect.
Right. And
he's
Mr.
67
Jones
years
is
old.
67 years of age, so no NHTs to be computed. But
Right.
Miss Whittle, while you're with us, you notice there was no education tax either.
That is also because of the same age cap.
Because of the age.
Yes.
Right. And you don't pay education tax on employment income beyond the age of 65. And remember, we would have said that he had employment income and the pension income, so he would not have been required to pay education tax either. So that is why we would have only accounted for NIS in this computation. Just thought I'd make that clear. Now, we're going to be moving to the next scenario. Not same scenario, but the next bullet point here. It says his income remained the same in 2024. So you are to calculate his income tax liability and net income for that year. So we're going forward now we are coming forward from 2023 to 2024. We would have just gone through the computation for 2024. No, I want you guys to work with me on this. So his gross income is going to remain $9 million. So he is still in receipt of pension income. And by 2024, how old would Mr. Jones be? How old would Mr. Jones be in 2024? Pamela, go ahead. Pamela?
He would have been 68 years old.
He would be 68. That is absolutely correct. And so he would be eligible for which exemption as a result of that, Pamela?
For the pension exemption, the same two, the pensionable exemption and the age.
The pension and age. Right. So he continues to be eligible for those. Now, what is the amount of the pension exemption and the age exemption for 2024?
Okay, it would be prorated. So for 2024, it's what, 207,530. Is that the figure?
Yes, you are correct. You are spot on.
Oh, okay. You would have
Yes.
to prorate based on 3/12 and 9/12. So it's 207 for 530.
530. You are correct. So what I'm going to ask my participants to do now is to compute Mr. Jones's statutory income for 2024. We know that he is entitled to age and pension exemptions. So once you apply the amounts, you should be good. So I want you to tell me what the statutory income for 2024 ought to be. Patricia, go ahead.
So the statutory income is 8,434,940.
Thank you very much. Perfect. That is correct. All right. So I'm going to ask somebody else now, another participant, to tell me what is the threshold amount for 2024. Sophia, go ahead.
Hello?
Yes, Sophia, go ahead.
Could you repeat the question, please?
Yes, what is the threshold amount for 2024 that we're going to be applying here now to Mr. Jones's tax computation?
$1,650,090.
Okay, great. Thank you very much for that. So I'm going to ask all my participants now to compute Mr. Jones's income tax payable for 2024. Pamela, you are on the target. You are on the ball. That is good. Okay, but let's just give a minute, Pamela. I'm going to take you first, but let's just give a minute to the others who are currently using the calculator or the brain or the iPhone or whatever the instrument is. Patricia, Pamela, why are you gone? All right, Patricia.
Oh, sorry, I'm not
Patricia?
gone. It's accidentally. I'm still working. Sorry.
You're still working?
Yeah, sorry.
Okay. All right, so I think this will take a little time. So one more minute and then I'll take the responses. All right, so that was Pamela. Pamela was first in line. Go ahead, Pamela. Anybody else ready? Patricia, go ahead.
Okay, so we're now in 2024 with the prorated exempted rates, right, of pension exemption of 207,530, the same for age exemption, and the tax threshold now being 1,650,090.
Yes.
Right? So that amount is now taxed at 0, and the balance of that and the 6 million is taxed at 25%, and the remainder being taxed at 30%. And so the total tax is 1,817,959.50.
Thank you very much. You are correct. You are correct. So the total deductions then it would be how much, Ms. Bowen?
Go ahead. Go again.
The total deductions for Mr. Jones in 2024 would be how much?
That would be the taxes plus the 150,000. That would be 1,667,959.50.
All right. I think you missed the digit. There's 1,967,000. You said 1,667,000.
My bad.
That is just a slip of the tongue.
Yes.
Yes. All right. But thanks for that.
You're welcome.
And we have now screened the response that each person should have. So if you notice, Mr. Jones's take-home pay is actually more in 2024 than it was in 2023. He would have gone home with 6.9. Now he's going home with 7,032,000 plus change. Right. But let us try to just dissect that a little bit. So the impact of the increased threshold and exemption on Mr. Jones's tax liability. We see that the increases in the pension and age exemptions have resulted in a reduction of his statutory income, and by extension, the income that is subject to tax at 30%. Because remember we said that statutory income is the gross income less all allowable exemptions and deduction. There was an increase in the exemptions, the amount of the exemptions available to him. And so that would have reduced his statutory income. Remember, you pay tax at 30% on statutory income in excess of $6 million. So to the extent in 2023, we saw that his statutory income was 8,690,000, right? And of that amount, the amount that the $2,690,000 would have been subject to tax at 30%, because we would then subtract 6 million from the total statutory. In 2024, the statutory income as a result of the increase in the exemptions would have decreased, the statutory income would have decreased to 8,344,940, right? Which is computed in a similar way to how it was in 2023. You take the total statutory and you subtract $6 million from it. So we see here that the amount of his statutory income that is subject to tax at 30% had actually decreased in 2024. So that is one leg of the impact of the increase, right? The other leg we're now going to be looking at, and we see that the increase in the threshold has resulted in a reduction in the portion of the statutory income that is subject to tax at 25%. Because in 2023, the threshold was lower, and therefore the amount subject to tax at 25% was higher. The amount of the statutory income was higher. Come 2024, with the increase in the threshold, we find that the amount of the statutory income that is subject to tax at 25% had decreased, thereby reducing his overall tax liability by $114,000 and $114,016.50. Right. So that is the impact of the changes, the increases in respect of Mr. Jones's income. Remember, ladies and gentlemen, to the extent in this instance, Mr. Jones had sufficient income to benefit from the 2 exemptions that he would have been entitled to, as well as the threshold. And so he got the full benefit. To the extent that he did not, if he did not, he might not have been able to benefit to this extent. All right, so always bear that in mind. We now go to questions, general questions about anything that you would have heard from the start to finish. Any question that you would want to verbalize?
Mrs. Williams? The participants are asking you to go back to the last 2 slides and to read.
Any questions going once?
Could someone relay to Mrs. Williams?
All right, just hold on a second for us. We're addressing a little technical issue here. We'll be right back with you. Okay, go ahead, Ms. Smith. Okay, go ahead with the questions, please. Any questions from YouTube?
Hi. Hello?
Yes, go ahead.
Hi. All right. So from way back earlier when you started, the threshold as it relates to fortnightly paid persons who we would have had 7 fortnights to the end of March. It sounded to me like you said at the end of this year, they should not be getting, they should not be entitled, or the threshold that they are is applicable to them should not exceed or fall below the 1.650090. Is that correct?
That is absolutely correct.
All right, so the calculation then would be for us to find the 7 out of 26 of the 1.5096 and subtract that amount from the $1,650,090, and then that balance is what we apply to the rest of the year from April to December.
All right, we understand that that is how you would approach it, but I suggest that you reach out to TAJ, reach out to head office, and just put your proposal to the persons there.
I don't think that is how our payroll would be set up to approach it. I think what we would do is at the 8th fortnight, which would be the first one in April, we would just start calculating at the 1.7. And then when you look at that, you put both together, it would amount to 1,646,242, which falls below the 1.65. So you're saying that's not what
Therein
should be the
lies
case.
the concern that we have, and that is why we ask that persons make contact with TAJ wherever they have a situation that is not consistent with what would have been presented here.
Okay, and
Because the employees are not supposed to be you're not supposed to apply less or more than the 1,650,000, $1,650,090 under any circumstance.
Okay, and
So
then
we would
reaching
look
out to
into your proposal and see how best we can accomplish that.
how do we reach out to you? Through the usual customer service numbers?
Okay. One minute. Okay, just reach out to the Commissioner General. You can send it to head office, not to customer service or any of our tax offices. Reach out directly to the Commissioner General of Tax Administration, Jamaica.
All right, thank you so much.
You're most welcome. Go ahead, Carmen.
Hello, I'm not Carmen, but may I speak?
Sure, go ahead.
Okay, my question. Thank you for the education. Because many people avoid all this tax business because it's just too complicated. So now that we are being educated, we have people who have not been filing returns, annual returns, but seeing with these changes in the amounts and all of that, if they file their returns now, would they be able to get their age exemption, and would there be a penalty for late filing?
Okay, to the extent that you file, an individual files an income tax return with tax payable and that return is late, then the system will automatically apply the late filing penalty.
Okay. Is it a lot?
But you may file and you may file.
Okay. I was just wondering if it's a lot because I know the person doesn't get a lot to pay, but you know.
Right. You have the you may file. There's a provision in the Income Tax Act that allows for a waiver of the penalty. I'm not here broadcasting that everybody must file and apply for waiver. It's at the discretion of the commissioner.
Okay.
Right.
And you
So
write to
I
the commissioner.
suggest
You write to the commissioner for that.
no
For the waiver.
Yes, you would write to the commissioner for that.
Okay. What's the
then you're saying something?
No, I was asking what's the address for the commissioner?
116 East Street, Kingston. Yes. Donald Sangster Building, 116 East Street, Kingston.
Okay, okay, thank you.
You are most welcome. But bear in mind as well the statute of limitation. So we don't want you to go back and file returns beyond 6 years.
Oh no, not so.
So that's another thing to be mindful of.
Okay, thank you.
Mrs. Williams?
Yes.
Just to add that waiver applications are done online now.
Thank you very much,
So,
Debbie.
mhm.
Yes, thanks for that. Thank you very much for that.
And since
thank you,
I
thank you
have
too. Okay.
I have you now, Colleen. There's a request for you to go back to the 2024 calculations. There's also a request for you to go back to the last 2 slides. I would imagine the slides with the example. And
Okay.
somebody also wants to look at the revised calculation for Jones. So I think you should just go
Okay.
back to your worked example.
So thank you very much, Debbie. In respect of Mr. Jones, do we start from 2023 or we start at 2024? I heard 2024.
Someone is asking, could you put up back the 2024 calculations? And then someone else wants to see the revised calculations for Jones. So if we have,
Okay,
put them back up.
Thank you. We'll do that in a bit. Okay, then. So the person who wanted to see the 20, I'll come back to you in a bit, Miss Lindsay, but somebody wanted to see Mr. Jones's income tax computation for 2024. Is it that you have a question or you just wanted to revisit? Miss Brissett, do you have a name for the person who wanted to see 2024?
Well, there are a number of different persons that are
A number of persons.
Right, but there's a particular request here from Raquel. And
Yes.
Raquel wants you to display the last question slide, the one that came before the 2023 and 2024 calculations.
Oh, thank you very much. So I'm now displaying scenario 4. Is there a question in respect of scenario 4? Was it Raquel that okay. Patricia Brown, go ahead with your question. Bowen, sorry.
It does not necessarily arise from this presentation, but when we have refunds, as you mentioned earlier, it does not, if we have 3 employees, for example, and the refund for that person is more than the tax for the others, and it ends up in a net refund for example, the PAYE, we're not able to put a negative figure on the platform. Do you think that will be addressed shortly?
In terms of the time of addressing that, let us look at what the issue is, though. You are within the year. the employer is legislatively allowed to make the refund. You're saying when you're filing the S01 in any month where your refund exceeds your tax payable, you're not allowed to account for the negative.
Right, for that particular tax type, the PAYE.
Pardon me?
Yes, for that particular tax type, the PAYE.
The PAYE, because really and truly, to do that would be to say that the employer is the one who is entitled to the refund, and that is really not so. So it is a matter that we will look into, but legislatively refund in respect of PAYE, while the legislation allows the employer to make the refund during the year, because any refund that is to be made after the end of the calendar year, the employees would have to apply for it personally. So I guess it is against that background, but it is something that we could look into and talk to you some more on. But at present, what comes to mind is the fact that refund in respect of employees is not really a refund to the employer. And if the employer is able to account for it on the S01, then that is what it would be saying, that they are entitled to the refund. So a workaround could be to refund up to the amount in any given month. You refund up to the amount of the tax that you have payable, and then carry forward the rest of the refund to another month when you have tax payable.
That is what is being done. However, it depends on how much refund that individual is getting. As I said, there would be, for example, 3 persons on the payroll, but that one refund is more than the other 2 taxes combined.
And that is the case every month?
No, just on particular occasions. But on those occasions, we have to take out the negative and file for the other 2.
But you could set it to 0. So you'd have to make some adjustment between what your payroll is, because your payroll will show a negative, an overall negative figure, but you are not allowed to refund more than the tax payable in any period.
No. All right, so 3 of us are on the payroll. You are getting a refund, right? However, your refund is $6,000, right? My tax is $2,000, and another person's tax is $1,000. So we end up with a net of $3,000. And I can't file that net $3,000. So what I have to do is put that 6,000 to 0, that minus 6,000 to 0, so that I can file.
Right, but that is what I'm suggesting, that you, in any given month, if you're saying that I'm to get 6,000, no, but you set the full 6,000 to 0, because based on the scenario you give, there are 2 employees who has an amount payable of $2,000 each.
Yes.
Which would be $4,000, which would be payable to TAJ. And
Yes.
what I'm suggesting to you is that you can make refund in that month up to $4,000, and then set your payable in that month
Okay, I
to
get you.
0. And then the balance of the refund, you take it another month when you have tax payable.
Okay, I get that. Thank you.
Okay. Because the PAYE is really not necessarily refundable to the employer. Yes. Thanks for that question. Sophia, go ahead. Sophia,
Sorry,
unmute your mic and go ahead.
my question was answered. My question was answered was asked by another person. So I got my answer.
Okay, great. Any other question? Romain, go ahead. Romain, please unmute.
Okay. You hearing me now?
Yes, loud and clear. Thank you.
All right, great. I know well, I shouldn't say I know. I think I remember the minister, some report was saying that some folks, based on how they earn, will be getting a tax credit based on their income tax. That they paid over the past fiscal year. Is that really so?
Progress.
Could you please repeat for me?
Okay, I was saying that some time ago, I don't remember if I read it or I heard it said, that some folks who have earned a certain amount and pay income tax on it will be getting a tax break, a tax credit, sometime this year and based on what they have paid. Is that correct?
Okay, so you might be speaking of the reverse tax credit.
Right, something of the
Is that
sort.
what you're talking about?
I think that's what I saw or heard, and I don't remember.
Okay. So the mechanism by which that will operate is being developed as we speak.
Oh.
And so you will hear more about that at a later date.
I see.
Okay.
That would be wonderful for a number of people.
Mr. Smith?
Hi, afternoon. How are you?
I am fine, thanks. How are you?
Wonderful. Doing okay, thank you. Going back a little bit to the refunds. The young lady spoke about the refunds on the payroll and the SO1. My experience is similar because the SO1 is filed per person, as you're well aware. Then the system will not allow you to put in a negative for the PAYE, so you have to zero it. So there's always going to be a reconciliation between what you have filed and what your payroll records is saying as it relates to that individual. So the scenario, I think my understanding of what you said with that 6,000 versus 3,000, and you can just zero the total. No, you have to zero the individual. So you would have zero for individual one, and the other two persons have a tax amount.
Okay, so you're saying it's a $6,000 that would have to be zeroed?
In full, yes, because it's tied to an individual. And the individual's record cannot take the negative. It has to be zero or positive.
Okay. All right. So we'll look back at that.
Sure.
Okay. Any other question? Wayne, go ahead. Wayne, unmute your mic and go ahead. All right, is there anybody else who has a question? All right, so would that be it for the questions? Is there any question on YouTube? No? Okay. Okay. So we're going to know, somebody had asked for scenario 4 to be screened again. And I was waiting to hear if there's a question in respect of scenario 4. So I guess the person probably just wanted to see. Then I will now move to the computations. And this is the one for 2023. Any questions in respect of this one? No questions. So where probably the person just wanted to take a picture or something. All right, and this is it for 2024, the calculations for 2024. Any questions? Go ahead, Wayne. Wayne? Please unmute and ask the question.
Hello, can you hear me? Hello?
Okay,
Can you hear
yes,
me?
I'm hearing you.
Yes, I had some problems unmuting a little while ago. I finally was
Okay.
able to unmute. I
Okay.
don't know if I missed it, but I was wondering, you read the scenario that you gave for 2024. I don't know if you had applied it to the fortnightly pay. I know it would be a similar principle, but I just wanted to see the application to a fortnightly scenario. Somebody who receives fortnightly pay.
Okay, as opposed to a monthly
Yes,
pay.
as opposed to the monthly scenario, yes.
Right. So what you would do, the only I don't have a computation to screen for you in using the fortnightly pay cycle. But what you would do is it depends on which fortnight no you're going to be looking at. Because if it is a fortnight that is for January to March, then the exemption would be for that period 1/3 of the $20,000. If it is a fortnight, sorry, 1/3, no, it wouldn't be 1/3, it would be there would be 6 fortnights. There would be 6 fortnights, sorry, in the period January to March, right? So not 1/3, no, 1/3 is the month. I guess that's stuck in my head. But it would be 1/6 of the $20,000 for the fortnight for each of these exemptions. right? And in terms of the threshold, it will depend as well on whether it is January to March or April to December. You would apply based on what was presented on the table. And if you go to the technical advisory on the system, it gives you a table that outlines the threshold for each fortnight. So that would be the difference in terms of the calculations here. Possibility is $9 million, $8 million. So possibility is that the person would still be in excess of the statutory income may still be in excess of would still be in excess of 500,000. And so the 30% rate of calculation would still come into play. But the only thing that makes a difference here is the amount of the exemption and the amount of the threshold. So once you pick those up, and they are available on our website on the technical advisory, they will be available in the slides here. Once you pick those up and apply them, then you should be good to go. Have I answered your question?
Yes, thank you very much.
You are most welcome. Any other question? Two more questions? Any other question? Going once? Going twice?
Just before going twice, I want to step back a little bit to the pension exemption. You were to point out that it's the pension income from an approved fund. And in the scenario we had with the UK pension, that would not apply because it was not have been an approved fund here in Jamaica. What if you have a taxpayer who is in receipt of two pensions, one from overseas, one locally? Clearly, from what you have said, then the overseas portion would not apply. So that person could end up with pension income, local pension income that is below the exempt amount, the new exempt amount now, and therefore part of the exemption would just be forfeited.
Okay, so let us go back to that. You're presenting a situation where there's a pensioner who is in receipt of pension income from an approved source here in Jamaica or one of those statutory pension schemes.
Right.
But that person is also in receipt of pension income from overseas.
Correct.
Right? That's this picture you're painting.
Yes.
No, by virtue of the fact that the person would be in receipt of pension income here in Jamaica, that person would be eligible for the pension exemption.
Right.
What we would now need to look at is the person's age to see how that pension exemption is going to be applied.
Okay. So let's say the person is over 65.
Pardon me?
Let's say the person is over 65.
Yes.
Right? And I'm just kind of thinking, let's say a person over 65, the pension income from Jamaica, from the approved scheme, is $200,000. As of 2024, we know a maximum of 207 is available. So would that mean that the other 7,000 is just forfeited, even though there's pension income coming from overseas?
Right. So the pension, if the person is, what is the age? Remind me of the age of the person again.
Anywhere over 65, right? Well, right now I'm looking at
The
somebody who
person is over
80.
65, but the
Correct.
person would have met the criteria because remember when we spoke of pension, we said that for persons who have attained the age of 55 years, they may utilize the pension exemption against their income from all sources. So you are saying that for their income from all sources. So
And
for
also,
somebody who is over 67, that would apply.
all right, and all sources here also includes the pension income from overseas.
Yes, it would,
Awesome.
because what we're saying here, the
Awesome.
distinction here is that the pension income from overseas would not entitle, in and of itself, would not entitle the person to the exemption.
Right.
But by virtue of the fact that the person has pension income in Jamaica that entitles them to the exemption, they can now utilize the exemption. And by virtue of their age, they can now utilize that exemption against their income from all sources.
Fantastic.
Got the distinction there?
Yes, thank you. Happy.
You are most welcome.
Mrs. Williams?
Okay.
Mrs. Williams, are you here?
So I have a question where somebody is asking about a template. I don't have a template to be issued to demonstrate a template that you can use to compute your payroll taxes. However, if you go to the technical advisory, it will illustrate how the computation is to be done. Debbie, go ahead.
Colleen, did you have a slide that spoke to the rates for statutory deductions for employment as well as self-employment? Because
No,
there's a couple of questions asking about the rates for
for
self-employed.
self-employment, we could speak about them, but statutory deductions for employment we had. But I could also speak about the rates for self-employment.
Go ahead.
In respect of self-employment, the rate that's applicable is 3% of statutory income. And let me just say, the employed person pays NHT on their gross income. The self-employed person pays NHT on statutory income. And that is according to their legislation. Right? So for NHT, the self-employed person pays NHT at 3% of their statutory income. In fact, the self-employed person pay all statutories on pay all deductions on statutory income. May I repeat that? The self-employed person does not pay any deduction on gross income. They pay all of their statutories on their statutory income. NHT is no different. So they pay 3% of their statutory income for NHT. They pay 6% of their statutory income for NIS. They pay 2.25% of their statutory income for education tax. And in respect of income tax, they too have the same three-tiered rate structure where the threshold is at 0. Every dollar above threshold up to 6 million is subject to tax at 25%. And every dollar above 6 million of statutory income is subject to tax at 30%. Have I satisfied that person? Have I answered the question? Debbie, is that
Yes, I believe you would have answered.
sufficient?
Yes, Colleen, I think that's enough.
Miss
Okay.
Colleen, hello. In
Yes.
addition to that, do you want to speak to if the person has attained or is over 65 and is self-employed, or for the contract, if NHT, NIS, and ed tax should be deducted?
Okay. So if the person has attained the age of 65, they are not required to pay NHT. The self-employed person who has attained the age of 65 years is not required to pay NHT. The self-employed person who has attained the age of 65 will continue to pay education tax for as long as they have set the income, self-employment income. So where you have an individual who is employed, because you do have a number of those persons, you are employed, but you also have self-employment income. Upon attaining the age of 65 years, you cease to pay education tax on your employment income. However, you will continue to pay education tax on your self-employment income. Miss Marie, have I left out anything?
And does that apply to NIS and NHT? For the income that is not employment income?
No, for NHT, there is no difference between employment and self-employment. Once you have attained the age of 65, you cease to pay NHT regardless of your source of income. And for NIS, the rule about the deemed retirement age also applies for the self-employed person. So your retirement age would normally be 65 years, but to the extent that you continue to have what their legislation refer to as insurable income, you continue to pay NIS until you attain the age of 70 years.
Does that address your
if you
question,
have,
anonymous
say for
attendee?
example, rental income, you'll continue to pay NIS on that until you have attained the age of 70 years. If after 70 years you still have that rental income, you're no longer required to pay NIS.
Anonymous attendee, I hope we have addressed your query.
Another question, Marie?
No, I was just saying that I hope we
Could you
addressed
please
it
repeat that for me? I didn't get it.
The questions were coming from anonymous attendee. I'm just pointing out that I'm hoping that we have addressed the query adequately.
Okay, go ahead, Donna.
Yes, good afternoon again. I was just asking if the three-tiered system that you mentioned,
yes,
is it an example of a progressive tax system?
It is.
Thank you.
Carrie-Ann, go ahead.
Good day, afternoon. We have persons in our employ who we know to be self-employed otherwise, and so how we treat them is that we do not give them the benefit of the tax threshold any at all, and we do not.
I'm going to ask you to repeat in a little while. I missed a part of what you had said, but just give me a couple seconds and then I'll give you the go ahead. Okay. Please repeat the question for me.
Okay, we have persons who are not fully employed by us. We just give them a contract for a period of time, and we know that they're otherwise employed. And so we do not give them the benefit of the tax threshold, neither do we deduct the NIS deduction from them, given that there's a ceiling for that. I am just checking in to ensure that we're handling that properly, because I visited the NIS office and they were saying that we were doing it wrong. Just need some clarity.
Because their employment status with you is not dependent on the fact that they are employed elsewhere. You need to look, once there is supervision, direction, and control being exerted by your organization in respect of what these people do, they are your employees. Even because employment does not have to be continuous, it does not have to be full-time. What you look at are the principles of direction, supervision, and control. You look at things like who bears the risk of what these people do. So once those things are in the affirmative, then the persons are your employees. And by virtue of them being your employees, under the second schedule of the Income Tax Act, you're required to withhold. And in accord, the other statutory deductions, the legislation governing the other statutory deductions, they say that the deduction requirement, and I'm just paraphrasing now, under the Income Tax Act also apply to them except where stated otherwise. So any income that is subject to income tax, generally speaking, to deduction, to withholding, right? Except for those that the NHT Act specifically say are not applicable for NHT, that there should be no withholding. So the withholding requirement, once the withholding requirement for income tax is there, then it follows that the other statutory deductions, there's a withholding for those as well, except where those legislations state otherwise.
Understood.
And as an employee, because one of the things is where a person has more than one employment, we ask that they account for, they have an obligation to file a return at the end of the year. Right, so as an employer, you are required to do what employers are required to do, and that is to apply threshold, apply the statutories in accordance with the legislation. I realize that this is morphing into a payroll session, and probably at a later date, we could have a full-fledged payroll session, and that will be discussed. I'm not announcing that we're going to be having one. It is just a thought that came to my head where we could address all things payroll. Yes. Go ahead, Debbie.
Oh, I don't know if Pamela is still interested, because she was asking you to review the cumulative approach because she had joined late and it was not clear. So Pamela, are you still interested? Or if not, you can access the presentation on our YouTube channel and, you know, go through it yourself and see if you are much clearer.
What was the point of misunderstanding, Debbie?
She just said she wants you to review the cumulative tax approach because she had joined.
Okay, because we had a challenge with the presentation, but it is on the website, on the technical advisory that is there. A similar example to what I was looking at is on our website.
Let me see if Pamela has responded.
Sophia Lindsay. Sophia?
That my hand was not lowered before, so I just noticed it.
Oh, so that's an old hand.
Yes.
Okay. When is this a new hand? Okay. Pamela Prince, go ahead.
No, I was making regards to the cumulative, but then you addressed it that I could view it on the system, so I would proceed in that approach.
Okay.
Thanks much.
You're most welcome. Dania? Go ahead, Dania. Please unmute.
That's an old hand.
Oh, I may ask all the old hands to kindly be lowered, because we want to be able to see those who have not yet been served. They're all low. Okay. All right. So all the. All right. What I'm going to ask you to do is to type your question in the Q&A and let
Hello,
us
you
see
can hear me?
Miss
Oh, you
Brissett
can hear me?
or any of our chat monitors will either relate to
Hello?
us, they will address it.
Oh, hello, you can hear me?
Yes.
It was just a follow-up, just a quick follow-up related to a call about two calls ago about the deduction of tax without applying the threshold, where they have a contract. I've come across something similar, and I understand that there's a section of the Income Tax Act that deals with contract for personal services, where, for instance, if you have persons who are teaching for a few hours, say at a college or so on, and they're only, say, example, coming in the afternoons to teach, and they're on a contract, and it might be for 3-4 hours, and it is understood that they have other employment in the day, then I think the Income Tax Act allows for you to deduct just the income tax on that payment alone. And I think that the other deductions might not be made in that case.
Okay, I think you're speaking about section 51C9, and there was a recent case, court case on that. But 51C9, persons who are captured under 51C9 are deemed employees. That was what that case revealed. That was the finding of that case, that those persons are deemed employees. And so by virtue of them being deemed employees, then they ought to be treated as employees.
Okay,
so
noted.
the only place I can think of is section 51C9. And when you go to section 51C9, it does speak to direction, supervision, and control. So that is why that's one of the basic criteria. And you're not, because it is one of the other things that persons tend to say, that section indicate that you're only to withhold income tax. You would never find in the income tax any provision that says you're to withhold NIS, NHT, or anything. right? So that once it is once the employment, you're providing personal, independent personal, once you're providing personal services, and personal services has a definition. It is not all services. There's a specific definition for personal services. Once you're providing any of those under the conditions as are outlined in section 5(1)(c)(9), you're a deemed employee and you're to be treated like an employee.
Okay, noted. Thank you very much for that clarification.
Ingrid Johnson. Is that an old hand, Ingrid?
Yes, it is. Yes, it is.
It is an old hand. I'm asking that all the old hands be lowered. Thank you. Judith? All right. So we're going to be taking 3 more. Judith
Yes.
is the first of the 3. And then we're going to be closing off. Go ahead, Judith.
Thank you so much. There's a retired person, 75 years old and a bit, who receives an NIS pension, but has to be self-employed via facilitating workshops on contract, not on staff anywhere. Would this person benefit from the age exemption, the pension exemption, and the total income tax exemption if my total income falls below the official threshold?
All right. So divert, let's take them one at a time.
Yes, thank you.
75 years old, the age is 70 or 75?
I am more than 75.
You're more than 75. So you are more than eligible for the age exemption.
Good, thank you.
Right. You are in receipt of pension income from a statutory scheme.
Yes, from NIS. That's the only pension I have.
Right. So you are eligible for the pension exemption.
Mm-hmm. Okay.
Right. No. The other part of the question, you asked about another exemption if you are below the threshold.
Yes, in other words, in order to really survive, I have to do extra things like facilitate workshops.
Right.
So all of those come to less than the official threshold. Do I qualify for that exemption?
All right. So what you find, all right, let's work with a figure.
Yeah.
Say your total income for the year is $1.5 million.
Yes.
And up to last year, your 2 exemptions would have been age 80, pension 80. So that would be 1.5 million less 160,000. And
Okay.
by my math, that would leave 1,340,000. Please help me out here, guys, with the maths. I'm going out on a limb. 1,340,000. Last year, the threshold would have been $1,500,096. You would still not be required to pay any income tax because your statutory income of $1,340,000 would be below the threshold.
Okay.
Have I answered your question?
Yes, thank you very much.
You are most welcome.
Can you remind me the number or the description of the forms that I'm supposed to fill out? You gave out 2 at the beginning, but I didn't get the right number.
Okay. You are, based on what you have outlined to me, You have
Mhm.
self-employment income, and so you'd be required to file the S04A, which is the
S04A.
estimated declaration for the current year, and the S04, which is the annual return for the year.
Annual returns, and the other one is the what we describe the other one properly? When you give an assessment of what you expect to earn,
that's the estimated declaration, and that's the S04A.
Estimated declaration. And if I missed last year, is there a penalty? I didn't file?
Okay, if to the extent that your income is below the threshold, you would not be required to pay any tax. And so the penalty the system would not automatically apply the penalty.
Oh, nice. Thank you very much.
You are most welcome.
Okay, this has been very helpful for me. Thank you very much.
Okay, I'm happy to be of service to you.
Yes, ma'am. Thanks again.
Okay, 2 more questions. Sophia, is that an old hand or a new hand?
That's an old hand.
Old hand, all right. Joan Bogle? Old or new?
Just new. I've been trying to go on for the longest while. Okay, there, as I said, there was a question. The first scenario, 2023 with Mr. Jones. Can you put that slide up, please?
Mr. Jones, that's scenario 4?
Mr. Jones, 2023.
Would you like, do you have, is it the question or the computation you would like to see?
Computation.
Joan?
I am seeing the question, scenario 4, but I would like the computation.
The computation?
Yes.
All right, so that's the computation for 2023.
Yes. Thank you very much. I just wanted to look it over.
You are most welcome.
All right, thank you. That's it.
All right, so now that we have, answered Joan, we have satisfied Joan's desires. We now move to Debbie, and that's the last question.
Not a question, just adding to your instructions that you gave to Miss Judith. I would advise you, Miss Wedderburn, just in case your income from your workshops that you do exceed the threshold, I would advise you to make an application to TAJ for what we call a determined rate, so that it means that you can make use of your other exemptions that you have not utilized in full. You can make use of them against this workshop income. So just in case there comes a time when that income is now above the threshold, you'd want to take advantage of utilizing all your exemptions.
Okay, thank you. Thanks for that, Debbie.
Welcome.
Thanks much. Teamwork is dream work, eh? Right. So at this point, I'd like to just say thanks to all the participants. I trust that you would have benefited from the discourse. If you still have questions, please feel free to reach out to us and we will address them. I just want to say special thanks to the persons who are on YouTube. We saw you participating and, you know, we are truly grateful for that. I just encourage persons to keep their ears to the ground. Right now, we are conducting sensitizations in relation to the increased threshold, the revenue measures, but in the future, we would definitely will be having others. So just keep your ears to the ground and we'll certainly keep you in the loop. All right, so thanks for your time and attention. I will now hand over to Mrs. Walker.
Thank you. Thank you so much, Colleen. And thank you to our resource team. And thank you, everyone. You were very engaging and we appreciate your interaction with us. Let me just advise you that on May 8th, 2024, TAJ will be hosting another webinar for pensioners. So if you're a pension fund manager, you would want to hear this, or financial institutions, once you are relating to our pensioners, this webinar is being designed to assist you. So please look forward to our May 8th, 2024 webinar for pensioners. In addition, if you missed anything today, our YouTube channel is available. Feel free to tap in Tax Administration Jamaica YouTube channel, and this session you will be able to replay and clarify anything you missed. Thank you so much, and we look forward to serving you, Tax Administration Jamaica.
Hey, thanks for telling us about Flow Yard and Road. We save a whole lot. And the internet at home, bam, is